Hello, so in today's video, I'm going to be explaining what is a REIT. I'll also be showing you the different types of REITs. And then at the end of the video, I'll show you how a REIT would compare in performance to the S&P 500 and other major indexes. If you're new to this channel, welcome. My name's Andy. On this channel, I like to talk about money and success. If you're interested in either of those two topics, please do be sure to hit the subscribe button down below, hit the notification bell, and then you'll get notified every time I release a video. And if you enjoy this kind of content and find it helpful, please do remember to give it a thumbs up. That helps the YouTube algorithm, which in turn helps me. So with all that said, let's answer the question. So what is a REIT? A REIT is an acronym. It stands for Real Estate Investment Trust. Put simply, a REIT is a company that invests in property. Think of it like a landlord. Let's go to the slides and have a quick look. So as you can see, what's a REIT? Real Estate Investment Trust. So that is what it stands for. REITs, or Real Estate Investment Trusts, are companies that own or finance income producing real estate across a range of property sectors. These real estate companies have to meet a number of requirements to qualify as REITs. Most REITs trade on major stock exchanges and they offer a number of benefits to investors. Now, if they reach these requirements, they actually not only qualify as REITs, but they also get certain tax breaks in the US, which means they've got more profit that they're able to pass on. So let me just move on to what they need to do to qualify as a REIT. So how does a company qualify as a REIT? To qualify as a REIT, a company must invest at least 75% of its total assets in real estate, derive at least 75% of its gross income from rents, from rental property, interest on mortgage financing, real property, or from sales of real estate. Pay at least 90% of its taxable income in the form of shareholder dividends each year. That's a crucial point. So it's taxable income, it's profit, essentially. It has to pay out 90% of it by law, okay, to be classed as a REIT, which means you're guaranteed to be getting a good amount of money. If you want a company that you invest in, whereby you're going to be getting a good share of its profits, a REIT is one way of doing that, which is one of the reasons why they're so popular with investors, particularly dividend investors looking for something to give a recurring passive income. Because essentially, you're being a landlord without the hassles of being a landlord. Let's carry on. Be an entity that is taxable as a corporation, be managed by a board of directors or trustees, have a minimum of 100 shareholders, and have no more than 50% of its shares held by 5 or fewer individuals. So now, let's look at the different types of REITs, okay? Now then, essentially you can set them into two categories. You've got finance REITs, such as a mortgage REIT. You might see the term mREIT, for example. An mREIT is a mortgage REIT. They basically lend the financing to people to be able to buy property. And then they make their profit on the interest. So they'll borrow at one interest rate, rent out the money essentially at a higher interest rate, and the difference is their profit, and that's what they make their profit, and that's what they pay you a share of, okay? So that's a mortgage REIT, whereas a regular REIT, as far as I'm concerned, which is broken down into a number of categories, which I'm about to go through with you, actually owns the physical land, the physical properties, and those are broken into numerous accounts, for which I've got slides for. The one I don't have slides for is a farmland REIT. So just imagine you've come across a farmland REIT, that's one that owns a farm or farms, usually not a farm, it's rare to own just one, but own lots of farms, and they essentially rent that land to the farmers farm the land, have the cattle on land, whatever it is the farmers are doing, and the farmers then pay rent to that farming REIT, and that REIT then pays you a share of the profits from that rent. There are a number of other types of REITs, so let me just go through those with you now. Let's look at the slides. So we've got office REITs and industrial REITs. I think that's fairly self-explanatory. An office REIT rents out office space, and an industrial REIT rents out industrial space and warehouses, that kind of thing. Then there are retail REITs and lodging REITs. Retail REITs are very, very common. So a very popular one that would be classed as a retail REIT is Realty Income Corp. That one's famous for paying its dividends monthly. It has about a 5% dividend yield. I think at the moment just less than that, 4.something% dividend yield. But it's paid out monthly for the past, I think, 26 years and increasing in that period of time as well. So that's an example of one of those. And lodging REITs, there's lodging and hotel REITs. It's fairly self-explanatory. They own hotels and resorts. Then we have residential and Timberland REITs. A residential REIT, again, it's fairly self-explanatory. It owns property that people live in. A Timberland REIT, a bit like a farmland REIT, only instead of farming crops or cattle, it's trees. That's a Timberland REIT, okay? There's health and storage REITs. So a health REIT, healthcare REIT would be a REIT that owns hospitals or care facilities. This is actually a sector I really like. I own a few healthcare REITs. Storage REITs are also pretty good. I mean, in fairness, I like REITs. I've got to be honest. I'm a REIT fan. So hence I'm making this video for you. But yeah, storage REITs. So there are REITs that own storage facilities. There are infrastructure and data center REITs. Generally speaking, the data center REITs I've found pay a lower dividend, but they tend to keep growing. But still, that's good. And infrastructure REITs, literally, they own the infrastructure. So, for example, they might own cell towers, for example, something like that. Then we've got diversified and specialty REITs. So a diversified REIT will have a mix of property types. So it might own some offices and some shops, or it might own some industrial and some residential. It could be a general mix, hence diversified. And a specialty REIT, a good example of a specialty REIT is one I've purchased recently, EPR, which literally owns things like golf courses and ski resorts and cinemas. So again, you could argue it's diversified in that respect, but it's specialised because they're quite specialist things. You know, it might own bowling alleys and things. So it's not, you know, the specialised buildings. So that's essentially the different types of REITs. Hopefully that gives you a good idea of, you know, a REIT isn't just owning houses, as you may have initially thought. So now let's have a little look at how they compare in relation to the market. If you was to invest in REITs, how do they compare? Let's have a look at that. So over the long term period, REITs have generated almost 2 times greater annual total returns than growth investments. By that, we're talking the S&P 500. And as you can see in this graph here, the S&P 500 has grown by almost 7.5% per year over the past 20 years, whereas REITs have grown by 14% over the past, like year on year, over the past 20 years. So as a growth investment, REITs are very good, just as you would expect buying property is. So that really answers the question, I hope. What is a REIT? I hope now you feel you understand what a REIT is. I will be making other videos where I'll be sharing with you which REITs I personally invest in. I've already mentioned some REITs that I invest in some of my previous videos in my dividend investing portfolio video playlist. So if you want to check that out, please do. But other than that, thank you so much for watching. Again, if you've not already subscribed, please remember to subscribe. And that's it. Thanks for watching. Goodbye.